Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq. And Phil, with 5 weeks to go to the U.S. elections, and I'm sure this is all that we're going to be discussing, VIX futures are pricing in elevated risk around the election and for months afterwards. So it's not just fundamentally what we're thinking, but the market is actually pricing this in. Before we take a look at that chart, let's take a look at how stocks are actually performing. And it seems like the new economy stocks are leading the way again.
Yeah, that's definitely true if we look at sort of the last 4 or 5 trading days. But so far, September's been a pretty tough month. We got down more than 10% since the start of September, but the rebound we've seen the last 5 days has been good. It's sort of made back 5 of those percents. And you can see from the chart that the Nasdaq 100 stocks have outperformed since around about September 20 by a reasonable amount. And that's full of all these stocks we keep calling new economy stocks. You know, stocks like Nvidia and Moderna and Amazon, that are well positioned for coronavirus and working from home.
All right, let's take a look at that VIX futures pricing in the next chart here. What is this telling you with the graph here?
Yeah, so the VIX is a future that's based on the options, and the options basically price in the cost of buying insurance for a big market move. And so when you see that cost go up, you know that market participants are paying more for the insurance that the market moves a lot than they normally do. And in reality, realized volatility has been a lot lower than 20 for most of the last couple of months. So volatility prices have been elevated anyway, but you can see the sharp increase as we get to November. And then that increase stays pretty elevated all the way through the next few months as well. So it's been the case for a while. It's, since August 25, we could see that kink in the curve in the light blue line. But basically the market is charging a lot more for insuring a portfolio for November through for the next few months.
All right, and of course, let's take a look at some COVID-19 data. 1 million COVID deaths have been recorded globally.
Yeah, and 200,000 of them are in America, and we're obviously not 1/5 of the global population. But it's a kind of a sad milestone, but also a milestone that's worth looking at. And this chart today, we're looking at the deaths. You can see them, how they've changed through time and where they're concentrated right now. So you can see India is definitely increasing in terms of the percentage of the global deaths, and a lot of Latin America is a huge proportion as well. The US has not managed to compress deaths the same way Europe did, though, which is, from a developed markets perspective, it would have been nice to see us be 2 weeks behind in the uptick, but basically be 2 weeks behind getting back to near zero deaths. And you can see even with Europe's new case spikes, their death rate is still well below ours.
Yeah, even still, we're still continuing to see leisure industry pain. It seems as if the service sector is just going to continue to struggle as, I guess here in the U.S. at least, we're determining if there'll be a second wave or not.
Yeah, and I guess this is kind of the cost of trying to reopen things as quickly as possible. Is a lot of those high-risk industries, the consumers just aren't comfortable yet, and you can see that in the data. So obviously with summer, we've been a lot more comfortable go back to eating at restaurants, especially all the restaurants that are able to serve people outside. So you can see the restaurant bookings actually picked up pretty quickly, but it's still well below normal levels. But in contrast, you can see the airline passenger growth has completely stalled since America got that, what looked like a second wave, but the expansion of cases again. And the airlines are struggling to get more people flying. But what's probably even more pertinent is looking at the hotels, which right now are actually starting to see a decline in the average daily rate and the occupancies as well. So, it's really quite difficult environment for all of these companies that are in the leisure industry when we just can't get a cap on cases and get people to be comfortable being together and doing things like leisure activities anymore.
Well, one sector of the economy that's doing well is housing. And I can tell you anecdotally, where I live in New Jersey, they're not staying on the market and they're getting cash in over the prices being asked. It's really quite incredible to see this wave out of the urban areas into suburban areas with some more space.
Yeah, and it's a trend that we've been talking about. The home builders are doing pretty well, but you're absolutely right. And the data that we're looking at in the chart today basically shows that the inventory of new homes is at multi-decade lows right now. So what you're saying seems to be shown through with the data. A lot of people looking for new family homes are buying them up, and there's not many left. And that's potentially going to create some inflation in home prices. But it's not clear yet whether that's going to come through into the CPI in any meaningful way, especially with mortgage rates as low as they are. The cost of actually affording these homes has gone down significantly.
All right, Phil, thanks for joining us on Trade Talks.
Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.